Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host at AlgoBot, and today we're studying a strategy called Round Level Rejection Reversal. This one is a pure price action approach, which means it uses no indicators at all. Instead, it focuses on the psychological round numbers that traders all over the world keep an eye on. By the end of this video, you'll understand how it spots a rejection at these levels, how it decides to enter, and how it manages its stop loss and take profit. Let's get into it. So what exactly does this expert advisor do? At its core, Round Level Rejection Reversal is built on one of the oldest ideas in technical analysis, that price reacts at round numbers. Think of levels like 1.1000 on the euro-dollar or 1950 on gold. These are the so-called figure levels, the prices ending in 0.00 and 0.50. Because so many traders place orders around these numbers, price often pokes through them and then snaps right back. That snapback is the entire focus of this strategy. What makes this approach distinctive is that it uses no indicators whatsoever. There's no moving average, no relative strength index, no average true range, nothing that needs calculating and nothing that can repaint. The levels are known in advance, sitting on a fixed grid spaced by the LevelStepPips setting, which defaults to 50 pips, so it captures both the 0.00 and the 0.50 figures. The market this EA is designed for is flexible. Because every distance is expressed in pips derived from the symbol's own specification, the same logic adapts to foreign exchange pairs, metals, indices, or crypto, without hard-coding any price scale. It runs on a single time frame of your choosing, and the strategy notes that the 5-minute, 15-minute, and 30-minute charts tend to suit this kind of figure-level day trading. As for who this is suited to, it's really aimed at traders who already think in terms of support and resistance, and who want to study how a rejection at a key level can be defined in strict, rule-based code. This is educational material, not a recommendation. Like every strategy, it experiences losing trades, and round levels do not always hold. The value here is in understanding the logic, not in any promise of an outcome. Let's walk through the mechanics step by step. First, the EA builds an invisible grid of round levels. It takes the LevelStepPips value, 50 by default, and lays down evenly spaced lines at every figure. So on the euro-dollar, you'd have levels at things like 1.0850, 1.0900, and so on. These never move and never repaint, because they're just arithmetic on the price scale. The strategy only acts once per newly closed bar. On each new bar, it runs a few checks. If there's already an open position carrying its magic number, it does nothing, because one trade is managed at a time by the stop and the target. It also checks the spread. If the current spread in points is wider than the max spread point setting, it skips the entry to avoid trading in poor conditions. Now to the heart of it, the rejection. The EA looks at the bar that just closed and measures its lower wick and its upper wick relative to the candle's full range. For a long, it finds the nearest figure at or below the close. It then signals a buy only when three things are true together. The lower wick is at least the WickFrac portion of the candle's range. The candle's low actually pierced down to or through that figure, and yet the candle closed back above the figure, with the close still hugging the level within the touch pips tolerance. That combination says the round number was tested as support and held. The short side is a mirror image. The EA finds the nearest figure at or above the close, and it signals a sell when the upper wick dominates the candle. The high pierced up through the figure, and the candle closed back below it, again within the touch pips distance. That says the round number acted as resistance. Exits are defined the moment a trade opens. For a long, the stop loss sits just below the signal candle's low, offset by the stop buffer pips. That distance, from entry down to the stop, becomes the risk. The take profit is then placed at the reward ratio multiple of that risk, 1.5 times by default. The short side simply flips this, with the stop above the candle's high. So every trade carries a controlled, known reward to risk before it's ever placed. Let's read through the code as it appears in MetaTrader. At the top are the input parameters you can adjust in the strategy tester. LevelStepPips sets the spacing of the round number grid. Touch pips controls how close the close must finish to the level. WickFrac is the minimum rejection wick size as a fraction of the candle, and stop buffer pips is the cushion placed beyond that wick for the stop. Reward ratio sets the take profit as a multiple of the stop distance, and max spread points filters out widespread conditions. Now look at the long block. The line with math floor finds the nearest figure at or below the close. The condition then checks that the lower wick is at least WickFrac of the range, that the low pierced down to the figure, that the close finished above it, and that the close is still within the touch distance. When all of that is true, the stop is placed just below the candle's low. The risk is the distance from the ask down to that stop. The take profit is the ask plus reward ratio times the risk, and trade.buy sends the order. The short block below is the mirror image. Math seal finds the nearest figure at or above the close. It checks the upper wick, that the high pierced up through the figure, that the close finished below it, and that it's hugging the level. Then the stop goes just above the high. The risk is measured from that stop down to the bid. The take profit is the bid minus reward ratio times the risk, and trade.sell places the order. Both sides share the same clean, symmetric structure. Let's walk through this chart candle by candle and see the strategy in action. Notice the two dashed horizontal lines. The lower one, in blue, marks the round level at 1.0850, and the upper one, in red, marks the round level at 1.0900. These are the figure levels the EA watches. There are no oscillators here, no extra panels, just price reacting to round numbers. On the first couple of candles, price is drifting down from above, sliding toward that blue support figure at 1.0850. Watch the third candle closely. Its low spikes down and pierces straight through the level, dipping below 1.0850, but by the time the candle closes, price has been pushed back up and finishes above the figure. That leaves a long lower wick hanging beneath the body. This is exactly the pin bar rejection the strategy is waiting for. The lower wick is well over half the candle's range. The low pierced the figure, and the close came back above it while still hugging the level. The EA reads that as the round number being tested as support and holding, so on the next bar it signals a buy. You can see the buy entry marker right there. With the trade live, the stop loss is tucked just below that candle's low, a few pips under the wick. The distance from entry to stop becomes the risk, and the take profit is set at 1.5 times that distance above the entry. Now follow the next candles. Price bounces cleanly off the level and climbs, candle after candle, away from support. By the sixth candle on the chart, price reaches the take profit line at around 1.0886, and the long trade closes for a gain in this illustration. That's the support rejection playing out from entry to target. Now the market keeps pushing higher toward the red resistance figure at 1.0900. On the eighth candle, watch the upper side. Price punches up through 1.0900, printing a high above the figure, but sellers step in and drive it back down. So the candle closes below the round number with a long upper wick standing above the body. That's the mirror image setup, a rejection of resistance. The upper wick dominates the candle, the high pierced the figure, and the close finished back below it within the touch tolerance. So the EA signals a sell. The sell entry marker appears here. For this short, the stop loss sits just above the candle's high, and the take profit is placed 1.5 times the stop distance below the entry. From there, price rolls over. It falls through the following candles, away from the resistance level, and by the 11th candle it reaches the lower take profit line near 1.0868, closing the short in this example. So in one sequence you've seen both halves of the strategy. A lower wick rejection that held support and led to a long, and an upper wick rejection that held resistance and led to a short, each with its stop defined by the rejecting wick and its target set by a fixed reward-to-risk multiple. Remember, this is a clean illustration. In live markets, levels can break and trades can hit their stops, which is why disciplined risk management matters. That brings us to the end of our look at round level rejection reversal. We covered how it builds a grid of psychological round numbers, how it waits for a single candle pin bar rejection to confirm that a figure held as support or resistance, and how it defines its stop just beyond the wick and its take profit as a fixed multiple of that risk. We also read through the actual MQL5 code and watched both a long and a short play out on the chart. Remember, everything in this video is educational content only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses are part of it. If you found this helpful, please like the video, Subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with the strategy you'd like us to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.